In my many years as an investment professional, I've seen many clients make wrong decisions or be given wrong information because of a basic lack of advice. My name is Brandon, and I'm an employee here at Nomad Capitalist. And I'm here to give you some basic information that will help you make better decisions in your financial future. A lot of individuals often ask me, what's the difference between a stock and a bond? Which one should I invest in? What's the difference? Which one is better for taxes? Which one am I going to make more money in? And I'm here to give you some unbiased information as to what are the two and what you can do about your investment future. The first is that stocks and bonds are very similar because they're ways that companies can raise capital. Companies need to be able to have money themselves, to be able to grow their business, invest in their employees, invest in their products, and expand. The two basic ways that companies are able to do that is either borrowing, which is a bond, or in selling part of the company, which is stocks or equity. Both of these serve a similar purpose, but one is purely to be repaid, a bond, and the other one is where profit should be distributed, or a stock. So which one is better? Which one makes more sense for you? And which one will help you with your financial future? In looking at equities or stocks, there are pieces of ownership of a company. Similar to you starting your own company and saying, hey, I would like to sell you 50%, a share functions the same way. A single stock unit is a share of that company, which means you own that fraction of the company's assets or what they hold, the building, the equipment, all of the hard items, as well as a share of the future revenues or profits from the company. Profits being the revenue minus the expenses. So how can you make money? What determines the stock price? And why do people say it's more volatile or risky? Well, first of all, stocks very much depend on the companies that you're investing in. You could choose to buy shares of a very stable company who has day in, day out, has income, very slow growth. These could be consumer products, Procter & Gamble as an example, or you can invest and go for growth stocks. It may not have great potential today, but it has very good potential possibly for tomorrow. These are typically industries like technology, biotechnology, or any up-and-coming industries. But it all comes down to the volatility of the profits. So what do you expect as a shareholder? There are two things that you hope to receive. One is that each share will hopefully appreciate in share price. Today it might be $20. Tomorrow, hopefully it goes to $22. And that $2 difference, or your capital gain, is what you're hoping to get, which you only realize at the time of sale. In holding the shares or stocks, you also hope to receive a dividend. A dividend is a distribution of profits from the company to you as the owner. That dividend could be given as frequently as every month. It could be given every year. It could never be given. And it all depends on two things. One is the profitability of the company. And number two is whether or not the company decides to provide the dividend. Why wouldn't they provide the dividend if they have a profit? Well, first of all, they may decide that they can invest that money into the company for a higher rate of return. Let's say they have a great project and they think they can receive 30% return by investing it internally. That money will then recoup itself and become a higher value for the shareholders. So it all depends on the decisions of the company and what shareholders expect around that profitability. So should you invest in stocks? Well, it depends on which stocks you're choosing. It depends on whether or not you expect to receive a dividend and you want current income, meaning money today, on a frequent basis or not. It also depends on whether or not you hope to realize capital gains and the taxes around that. In terms of bonds, they are very similar to a lot of the loans that you see out there. A mortgage is a type of bond between a bank or lender and you as a homeowner. But bonds are typically both for the government as well as corporations, where you as a lender decide to give money to them. So what are some things that you need to understand about bonds? Well, the first is, how much am I lending? Typically, bonds are sold in lots of $1,000, $1,000, €1,000, £1,000. But nowadays, you can invest in funds and other groups in amounts that you would like rather than individual bonds. You also need to understand, what is the coupon rate? Well, the coupon rate is the amount of interest that you will be receiving on a periodic basis. So, for example, if I buy a bond for $1,000 and it has a coupon rate of 10%, then I expect to receive 10% of $1,000 on a periodic basis. Let's say it's annual. So that means every year that I hold that bond, I get $100. So that for me is what I expect. I expect that the company does two things. One, it pays me that coupon or my interest as expected. And number two, that it has the ability to repay the loan at the end of the period. So bonds could have a period of a week, it could have a period of a year, or multiple years. There are some bonds, perpetual bonds, that go forever. So it all depends on how long you want to hold, if you want to hold on to that particular bond, or you would like to sell it on the secondary market. But how do I make money from bonds? We've already said that stocks go up as the company does better, as profits increase. Then you have higher capital appreciation, your share price increases, and your dividend may as well. But what about bonds? Well, bonds also fluctuate in price because the expected rate of return or the interest rate you expect to receive will change from time to time. So using my example of having a coupon rate of 5%, that's what I expect to receive from that particular company today. So how do I come to that 5%? Well, generally, there are three factors that influence the interest rates of bonds. One is, what is the actual risk-free rate within that country or jurisdiction that that bond operates in? So taking into account, for example, a US company bond, I would look at, what is the risk-free rate? The risk-free rate being, what is the minimal amount that I would need to get in return for lending money to someone, knowing full well that I'll get the money back. So if I know, for example, my best friend wants to borrow $100, how much would I expect at a minimum to get back tomorrow, knowing there's no risk whatsoever in lending him the money? It's the same with a company or government. So typically we look at things like the federal rate, we look at other interest rates that are publicly available, the interbank LIBOR, and we say that that is the minimal amount, knowing that there's no risk or minimal risk in lending. So let's say that's 2% today. For the other 3%, we look at, well, what is the inflation rate? How much am I losing in terms of the purchasing power of my money? Let's say that is anticipated to be 1%. So now I have 3% into my interest rate. If I then say, well, what is the risk that the company will not pay me either my coupon rate, my interest, or return my principal back at the end of the loan? So I have to factor in that amount. I may be investing in a company that is very stable. It gets enough cash flow to pay the loan every single period of time. Or I may be risking in a company that doesn't have stable cash flows and I expect more. So in this example, let's say it's a stable company and the further 2% is added to that. Well, all of those factors change day to day. We're now in a rising interest rate environment and a rising environment of inflation. So before, where I had 2 and 1%, maybe that's now 4% and 3%. So that's 7% interest that I expect to loan the money. And because of the economy, maybe that company becomes more risky. It's not so stable to be able to have the cash flow to pay back. So all of a sudden, I don't expect 2% compensation for the risk. I expect 4%. So my interest rate fluctuates day to day, but my payment stays the same. So in order to have the new rate of exchange, knowing that my payment is going to be the same, I should be able to adjust the basis that I have. So as interest rates rise and I expect a higher rate of interest, I will see bonds go down because I'm getting, for example, my $50 in my example, but on a lower amount, so my rate of return is higher. Equally, when interest rates go down and the factors related to that bond go down, then I should see the bond price go up because I still have my $50, which is 5% originally, but I may only now expect 3%. So the bond price goes up to compensate for that difference. So there is a change in price, there are fluctuations, and this is altogether changes the environment we're in. So there's one adage in investing that everybody should know. The higher the risk, the higher the reward. And normally in finance, we measure risk by volatility. By how much does a security price change? How often does it change? And does it go from 0 to 100 or from 0 to 1? And both stocks and bonds have high volatility, or can. Stocks by themselves are usually more volatile, but not necessarily, because they represent the future of the company in terms of their profitability and in terms of the expectations people expect to receive in terms of profit from those companies. In terms of bonds, you have quite a few stable types of offerings. You have high quality government bonds from stable economies like the US or Europe or Australia. But then you also have what are considered non-investment grade bonds or junk bonds, colloquially, that have a lot of risk. They may default, which means they will not pay you your interest or they will not pay you your amount back at the end. And there is risk in that. So to say that stocks are always riskier than bonds is not true. It depends on the company. It depends on the terms. And that's all what you have to weigh. You have to understand, am I buying a company or a set of companies that have low risk because they're very stable? They provide consumer products or products that will always be in demand. They have a stable management. Or am I investing in something that is a bit of a gamble? It's a new technology that may or may not come to fruition. It may not be the best managed company. In terms of a bond, do I have faith that the government or the corporation will be able to have cash flow to pay me back? Are they stable enough to make that payment every so often? That's the question you have to answer. So what choice should I make? Well, that very much depends on, for example, taxes. In most countries, the interest that you get on bonds will be taxed as ordinary income, which is normally much higher. In case of equities, you should be looking at, well, what is the tax rate on capital gains? Both short and long term. Short normally meaning less than a year of holding the security, and long term meaning longer. Oftentimes, there are tax incentives depending on those capital gains and the length of time. Also, some countries offer a tax break or reduce taxes for dividends to encourage investments in companies in that country. So you do have to look at your specific tax requirements and what is more efficient and better for you. The second thing you should consider is diversification. Why not both equities and bonds? Why not use different instruments like mutual funds or exchange traded funds, ETFs, and give you that complete diversity? Just as there's a tenet in finance that says the greater the risk, the greater the potential reward, the same is with diversification. The greater the diversification of assets you have, the greater chance you have to have stable income and less volatility. So ultimately, the decision is up to you, but hopefully this gives you a better understanding of what is the difference between stocks and bonds.